Every now and then, something from the past pops up online and just goes viral. Right now, it's this chart. It's over 150 years old, and it makes a pretty bold claim that it holds the secret to predicting the market's biggest moves. And honestly, you can totally see why people are freaking out about it. I mean, people are pointing out that it's seemingly called the dot-com bubble in 2000, then the huge financial crisis in 2008, and get this, even the COVID crash in 2020. That's a pretty wild track record, right? No wonder this old piece of paper is suddenly everywhere. But here's the kicker. This isn't just about the past. The chart is pointing to 2026 as the next big market top. And hey, 2026 isn't some far-off sci-fi date. It's coming up fast. So the big question on everyone's mind is, should you actually be worried? Well, before we either panic or just dismiss it completely, we've got to do our homework. We need to actually figure out how this crash calendar, is supposed to work. So let's break it down and decode its logic. Okay, so the chart breaks the market down into three symbol zones. The first one is Zone C. It calls these the years of hard times. You know the vibe. Prices are in the gutter, everyone's feeling gloomy about the market, and the chart's advice here is super clear. This is when you buy. Buy stocks and just hold on. Then you've got Zone B, the years of good times. This is the party, right? Prices are soaring, optimism is through the roof. It feels like the market can't possibly go down. And what does the chart say to do? Now is the time to sell, cash in, and take those profits. And last up, we have Zone A. This is a scary one. Years in which panics have occurred. Think crisis, fear, markets taking a nosedive. The whole idea here is that if you followed the rules, you already sold back in Zone B. You're supposed to be sitting this one out, safe on the sidelines. So there you have it. The rules of the game are buy low in Zone C, sell high in Zone B, and stay away from the panic in Zone A. Sounds pretty straightforward, doesn't it? But the real question is, does it actually work? Well, let's find out. We're going to put this old school strategy on trial using real historical data. First up, let's just focus on its buy signal. The plan is simple. We pretend we bought stocks right at the beginning of Zone C, the hard times, and then we just hold them until the panic of Zone A kicks in. And we're not just looking at a few years here. We've got data all the way back to 1877 to run this test. And wow, the results are actually really, really good. In fact, they're kind of shocking. If you followed the chart's advice to buy in Zone C, you would have been successful 87% of the time. Let that sink in. Almost 9 times out of 10, you would have made money. That is a crazy strong signal. So, okay, the chart is great at spotting those moments of maximum pessimism, those golden opportunities to buy. It's basically telling you when to have guts. But that's only half the story, right? What about the other side of the coin? Is it any good at telling you when to sell? And this, right here, is where the whole narrative just falls apart. Remember that awesome 87% success rate for buying? Well, the sell signal is a total disaster. If you followed its advice to sell during a panic, your success rate plummets to just 37.5%. You would have been wrong way more often than you were right. And it's not just that you were wrong. There's a real cost to being wrong. On average, by selling when Zone A hit, you would have missed out on a 17% gain in the market. 17%. All while you were sitting on the sidelines, waiting. It's proof that selling out of fear is just a terrible strategy. Okay, so the data is pretty clear. The what is simple. Buying when everyone else is scared works. Selling when you're scared doesn't. But to really get this, we have to go deeper than just the numbers. We need to talk about the why. And this has less to do with charts and a lot more to do with our own brains. I saw a great point from investment expert Ashi Samaya. He says that what feels like a total meltdown, a panic, is actually just normal. The market dropping 15 or 20% from its high, that happens pretty much every single year. It's not some crazy rare event. It's just the price of admission. And this is the genius part of his observation. The reasons for the panic are always changing, right? One year, it's trade wars. The next, it's a pandemic. Then it's inflation. The story is always different. But our reaction, that gut feeling of fear, that urge to just sell everything, that never changes. The panic itself is fixed. He has this perfect analogy for it. Picture this. You're on a bus on a really long road trip. For every 100 kilometers you go forward, some weird rule makes the bus go in reverse for 50 kilometers. Now, you're still making progress, right? You're still moving forward overall, but that backward part is super frustrating. And what do most investors do? They panic and they get off the bus right when it's going backward, completely missing out on the next big move forward. So where does that leave us? We've taken apart the chart, we've put its advice to the test, and we've dug into the psychology of why we react the way we do. Now let's put all the pieces together and see what the ultimate winning strategy really looks like. And really, this one chart tells the whole story. On one side, you have the fancy market timing strategy from the old chart. On the other side, you have a dead simple buy and hold strategy. And it's not even a competition. The simple, boring, patient approach just crushes the complicated timing strategy. So the takeaway here is crystal clear. After all that work, after digging into this mysterious 150-year-old chart, the most powerful strategy is also the easiest one. Just stop trying to be a genius and outsmart the market. It really all comes down to that old saying, which, let's be honest, has held up way better than this chart. It's that time in the market is so much more important than timing the market. Always. Look, the old chart got one thing absolutely right. Another panic, another big market dip, it's coming. It's not a question of if, it's a question of when. But now you know what the data actually says. So the only question left is for you. When it happens, what are you going to do? Are you going to see it as a threat and run for the hills? Or are you going to see it for what it is, an opportunity? The very same opportunity that chart was trying to point out in the first place.